to your Financial Legacy podcast. I am your host, Maria Ellis. On every episode, I will bring you my perspective and the perspectives of my clients on financial and estate planning. Here are the Financial Legacy podcasts. We're changing lives one person at a time to help you create, protect, preserve, and enjoy your financial success. Connect with us at financiallegacy.live for your complimentary consultation. Today, at the request of our clients, we will talk about planning for family business succession. And our special guest today, is Stephen Goodman. Stephen, welcome to the show.
Welcome. Thanks for having me, Maria. I'm looking forward to it.
Stephen is a very special person. He is very accomplished. He's been in business for many years. He's an MBA, he's a CPA, and he's an author. So we're in for a treat with Stephen. So let's go ahead and ask the very first question, Stephen. Tell us about your professional practice. How long have you been practicing and helping people through your advisory services to specifically high net worth clients all over the world?
Every time I'm asked that question, it reminds me how old I am. So
Yes.
I've been doing this for a long time, over 30 years. Started out in public accounting, worked for one of the big accounting firms, KPMG.
Yes.
Then worked as a VP in finance at JP Morgan. And for about 30 plus years, I've been doing, business succession, wealth preservation, estate planning for high net worth, super high net worth individuals, of which many of them own businesses, and many of those businesses are family held businesses.
Right. So, what's the best way to create a family succession plan? And I know it's very different for different people, right? But if we were to sort of generalize, what would you say is your ABCs or the very starting point?
Well, look, every business has a succession. Sometimes it's planned and sometimes it's not.
Correct.
Obviously, some businesses have family in them. Some businesses have partners that are not related. Some have key employees. Sometimes the succession is to sell a business. If we focus more on the family business, which is a lot of what I do, the first step obviously is you have to have people in the business to keep the business going. So it's hard to have a succession in a family business if the next generation has not made a decision to be part of the family business.
Correct.
So that's usually the first step. There's so many challenges as to why I find families don't do proper planning for succession.
Right.
Probably the two main challenges I've run into. One is entrepreneurs. They're entrepreneurs for a reason. They're risk takers. They're go-getters. They're always looking to find ways to, improve their business and make it more profitable. And thus, to plan means to take time away from things that need to be done today to plan for something that's needed for the future. So the first big obstacle is just getting their focus and attention, because it's not one meeting. It could take months to do a proper succession plan that requires multiple meetings, that requires continuity. You can't keep pushing off meetings, because then you lose the flow of what you're trying to do. So that's the first issue. The second issue is something that's a little even more difficult, and that is the emotional decisions that the entrepreneur needs to make. So as an example, my children are not in my business, but I have two kids and they're in their 30s. And, throughout all of life, you're always reminding the two of them how you love them the same, from when they're little
Right.
kids and you get one a lollipop and you got to get the other one a lollipop.
Exactly.
All through getting them a phone or an iPad or a car or whatever it is. And they're always playing you against one another, and you have to keep, telling them how much you love them the same. And most parents do love their kids the same. But at the same time, they may love them the same, doesn't mean they think all their children are equally motivated, intelligent, driven. So what becomes a very difficult task for the family business entrepreneur is, I have a kid in the business, I have kids not in the business, or I have more than one child in the business. who am I leaving this business to? Like, am I leaving everything equal to everybody, which
Right.
could cause major problems? Am I going to just leave the business to the child in the business and leave my other kids something else? I have two kids in my business. Am I going to give them everything 50-50? Or is it one going to be given control, which I'll get into a lot of these issues as we go forward. So what happens is that the business owner, more so a dad, at least in the 60, 70-year-old age group, it's going to change, obviously, as the generations go on. The
Right.
dad sits there and says, if I let all my kids know what my plan is, I know somebody's not going to be happy.
Right.
And not only is my children probably not all going to be happy, but their spouses are not going to be happy. And
Absolutely.
that could impact my relationship with my child, my daughter-in-law or son-in-law, and my grandchildren. I want to see my grandchildren. I don't want to have one of my kids, like let's say it's the wife of one of my sons, says, I can't believe your dad did this. This is horrible. I have no interest to keep a relationship with your father. And to be honest with you, I have no interest to have our kids spend any time with your dad and mom. And now all of a sudden, you've lost a relationship with your grandkids because of this. So a lot of times the entrepreneur runs away from the problem because they don't want to deal with it, because they know that if their kids find out what's going on, it's going to cause some issues.
Yeah, having said that, it's still so critically important to be able to have sort of a longer term plan for the business succession, because otherwise, like you beginning of the conversation, you said some people plan and some people just let it be, and that could be very costly. Another aspect that is related to the business owner that when it comes to succession is many of them don't want to lose control, right? It's like it's their baby. They have been working on it for 20, 30 years. They have built a fortune or certainly business legacy, and they like to continue that business legacy. But oftentimes it's very difficult for the entrepreneur to let go, especially when it comes to the financial aspects of the organization. So tell us a little bit about how do you manage expectations with business owners? How could they let go?
Well, look, I think you're making an excellent point. I think a lot of business owners, especially if they're the first generation that started the business, I think it's a little different when it's been passed down. But when you're the one who started the business, it's almost like another child.
Right.
You
It
treat
is
it almost
another
like a
child.
child as part
A
of your
very
family.
time-consuming child.
Right, right. So there's a lot of ways you could definitely do a lot of planning and not give up control. I mean, you could have voting and non-voting stock in a company. You
Right.
could maintain all of the voting shares. You can give away non-voting shares. You can give it away in trust. You could pick people as trustee that kind of are going to do what you want them to do. Ultimately, at some point, whether it's when you die or you get sick or prior to that, if you reach a certain age, you'll have to give up control. But to do effective and sophisticated planning, you could do a lot of that without giving up control. Where you sometimes run into a problem is if you give away assets, even if it's non-voting assets and you keep control, but if somewhere down the road you decide you want to sell the business, many times the lion's share of the proceeds end up not coming back to you because you've given away shares in the business, even though it's non-voting shares. And it could be in a trust, so you don't have to worry that it's going to get into your kids' hands or into their spouse's hands if there's a divorce. But some of those proceeds aren't going to come back to you. So obviously, one of the things you have to think about as an entrepreneur is what's more important to you, to start moving the process along and reducing your estate and reducing estate tax implications and doing succession, but giving up some of the proceeds if there's a sale? Or do you want not only control, but you want to have the asset, and thus if you sell it, you want the money and you don't care about the tax issues? I mean, that's a personal decision that somebody has to make. That's bad tax planning, but
Right.
that may not matter. That may be what the entrepreneur wants.
Yeah, it's really a priority for them. And, another bias that I have seen on entrepreneurs is the fact that even when they allocate certain pieces of the business for their children to manage, uh, it's like they feel like they're not doing as good of a job. Their children, their sons, aren't doing as good of as a job as they would have done. So again, you know, that's another challenge I think that a business owner has to realize, that they just have to let go and allow that son or daughter to, run their business in the way that is within the mission of the organization, but with having their own style.
I think that's a great point. I think another attribute of a lot of entrepreneurs is they're control freaks. That's kind of
Right,
how they got to be successful. The buck stops here. I want to make the decisions. I have to live or die with my own decisions. I don't want to delegate too much. And when it comes to their children, sometimes the parent has been a little bit of a control freak to their kids, and
right,
they're on top of them. Look, in reality, the smartest thing a business owner could do if they have kids involved in their business is, while they're actively in the business and they still are on top of what's going on, is to gradually let their children make decisions and let them make mistakes. Don't give them decisions that could be devastating to the
right,
business if they make a mistake, but small decisions, and each year give them more and more responsibility, and don't make them feel bad when they make a mistake. Let them learn, from the mistakes that they make, and tell them how you would have not only done it differently, but how you would have formulated the decision to do it differently, so that they could see how you think. Because just to say, oh, well, you did this and I would have done that, sometimes that doesn't help, because, well, Dad, like, how did you, or Mom, how'd you come up with that thought?
right,
So I think
exactly.
I think that that's very, very important to do that while you're active in the business, because God forbid you pass away and the goes to your kids and they've never been put in that position. The odds of the business succeeding is not very high.
Yeah, exactly. And I think having words of encouragement is very important. And like you said, allow the children or the sons or daughters to run pieces of the business, and perhaps make some mistakes, but those are mistakes that aren't that financially catastrophic. So it's almost like having a 2-year-old hold his of her hand and walk them side by side, teaching them how to walk. In this case, it's teaching your sons or daughters how to run their business. So, and we touched briefly at the beginning of the conversation about how different children have different set of skills. So, yeah, it's difficult for a parent to try to be fair and equitable, especially when it comes to those children who may or may not want to be involved in the business. So I know that, for instance, in order to provide liquidity to a business, life insurance is often a very good vehicle. Give us an example of how life insurance could be used in order to have an equitable distribution of the family and the business assets.
Well, you hit upon, great points. There's two different problem areas. There's the problem of kids in and out of the business, and then there's the problem of more than one kid in the business. So let's start with the first scenario of kids in and out of the business. So let's do a simple scenario, make it very simple. I have two kids, one's in the business, one's not in the business. Obviously, the more kids in and the more kids out, the more complicated this becomes. But
Right,
let's start simplistically. So look, most most of the time, if no planning has been done, what's going to happen is the person's going to die. They're going to leave everything to their spouse. And then when she or he dies, it's going to go 50-50 to their two kids. And you're going to end up with a disaster, because you're going to have two kids getting half of the business. One's in the business, one's not in the business. And that's going to probably lead to major issues. If you,
right,
if you're planning and you've come to the conclusion that I want to leave the business to my child in the business and other assets to my child or children out of the business, usually there's two big obstacles. A, the business many times is a disproportionate amount of the estate of the individual if it's a highly profitable business. So you could have somebody with a couple of $100 million business, and they don't have anywhere near a couple of $100 million in other assets.
right,
So So the first problem is, how do I make this fair? A key point to that, Maria, comes down to how much contribution did the child in the business make? I mean, if the business was a gigantic business before the son or daughter came in and they haven't really added value, then the dad or mom should think, I built all this. My son or
Right.
daughter didn't do this. So if I'm handing this child a $200 million business that they didn't really build, I got to give something of substance to my other child versus the business was here and the child took it to here, and
Right.
some of that value has been earned by the child. That's different. So let's go with the first scenario where they didn't really earn it. It's dad or mom created it. Well, you usually have a lot less assets out of the business to make fair to the other kid. Plus, you have estate taxes depending upon what the estate laws are of the country that you're in. So in the
Right.
United States, if I'm going to pass a $200 million business to my son or daughter, there could be $100 million of estate taxes due, which, if I don't have liquidity to pay that, let's say insurance, it's
Right.
got to either come out of my other assets, if in which case, what am I going to leave to my other child if I'm taking all the liquidity to pay the taxes on the business I'm leaving to my child in the business? Then I'm going to leave nothing to my other child.
It's a worse situation because you are paying so much in taxes, and you may even have to sell the business
That's correct.
because of lack
So
of liquidity.
you have two financial obligations in that scenario. There's a financial obligation to take care of your other child. Doesn't mean it has to be equal, but fair, okay?
Right.
And then there's the obligation to government. And usually there isn't enough dollars to meet both of those obligations if you don't acquire a sizable amount of insurance to provide the liquidity to do that. So the insurance could either be in trust for the benefit of the child in the business to help them pay the taxes, or the insurance could be in trust for the benefit of the other child as a way to create some kind of equitable distribution to that child because you don't have enough other assets. If you don't do that, then you're going to probably end up with the other child getting a lot less than is fair, and the child getting the business is going to be burdened with a major tax liability without any liquidity. And yes, they could pay it out over 15 years, and this is in the United States, but that could be a major burden on the business, which could force them to sell the business.
Yeah, because cash flow isn't necessarily guaranteed every year, just depends on the economy and what's happening, what's going on with competition and whatnot. So having a life insurance will be very important because it's also tax deductible, right? The business acquires it and you could expense it.
Well, no, you generally can't expense insurance because the proceeds are income tax free and
So it
potentially
has to come
estate
from
tax
the
free.
business owner personal income.
Yeah, it's usually, even if if first of all, you're not allowed to, if you were to deduct the premiums, this is in the United States. If you deduct the life insurance, you would have to pick up that as income. It doesn't really pay to do it.
Yeah.
It's more leverage. You'd rather not deduct the dollar of the premium, but
Right.
collect $100 tax free when you die. Those laws may be different in other countries. In the United States, that's how it works.
Yeah, absolutely. Thanks for clarifying that point. So let's see. Give us some examples of, when you have been counseling clients and they have a larger business with different offices globally, and maybe they have to restructure, reorganize their operations. Have you had, clients who have had to restructure, even if it is domestically?
I mean, restructuring of the business,
Yeah.
as if it's restructuring the business outside of planning for the estate, that's
Right.
generally not something I would advise.
No, so in terms of planning for the state.
Yeah. I mean, look, there's restructuring of stock ownership, the type of stock. You may only have one kind of stock today. You may have to set up non-voting stock and voting stock, recapitalizing the company to figure out how you could do proper planning. That all comes into play, in the planning. I mean, one of the things that I think may be helpful, Maria, is maybe I'm going to mention a couple of what I have found to be real problem areas in planning that
Okay.
I've seen. So here's a perfect example. I go when I have a meeting in this big giant office, big building, and I meet somebody who's appears to be in their late 50s, early 60s. They're sitting behind this big desk, and I go in and I meet with them. And one of the first questions I ask them is, what percentage of the business do you own? And they
Right.
say nothing. So I kind of think I know what happened here, but I keep going. Then I go, well, who owns the shares? And they go, my mother. And now I know what happened, but I keep going. So I say,
Right.
tell me what happened. Well, basically, my dad died prematurely when he was like in his early 60s. There was no planning done. I was already in the business. My sister and brother were not. When dad died, because there was no planning, he left everything to my mother. My mother has never worked in the business before he died or after. When my dad died, it wasn't a big business. It was a $5 million business. It's now a $100 million business. I grew it from
Mhm.
5 million to 100 million. So then I hit him with some things that maybe he thought about, but maybe he didn't. But by the end of this conversation, he's going to have indigestion. All right. So the
That's
first
right.
thing I say to him is, you do realize that when your mom dies, there's going to be estate taxes on a $100 million business. You're not going to be able to tell the government, well, wait a minute. When my dad died, it was a $5 million business, and I grew it to a $100 million business because your mom still owns it. When she dies, you're going to have to pay estate taxes on a business you grew from 5 million to 100. That's number one.
Mm.
Second question, out of the three siblings, who gets along the best with mom? Who gets along the worst with mom? So he says, the best is clearly my sister. She takes care of my mother. She sees my sister's kids the most. And the one who gets along worst is me, because
So
I'm
you know
always
the problem
fighting with
is
her
there.
because I want to spend money on things in the business and she doesn't want to spend the money. And I want to increase my salary. She doesn't want to let me increase my salary. So I said, do you have any idea about your mom's planning? Nope. She won't tell me anything. As a matter of fact, I don't even use the same lawyer that my mom uses because it's like a conflict. So I said, you do realize that when your mom dies, she could leave this business a third to your
Yeah.
siblings, and you would be in a minority position. Or she could leave it to your sister and brother who she gets along with better than you. He goes, that's true. I go, so you built a business from 5 million to 100 million. You're either going to have to pay major taxes on it, or you may not even get it or be in control of it when your mom dies. So that's an example of where a plan wasn't thought out. And look, to some degree, it's understandable. You know, dad was 63. His son was only in the business a couple of years. He wasn't ready to do planning yet. It was too
Right.
early. But
Right.
you know, the man upstairs decides when things start and end.
Yeah.
And
We have no control of that.
and you know, he could have had insurance to provide money to mom, so she felt comfortable giving up some of the stock, but he didn't really prepare mom. So mom needed the income from the business to survive. So she became nervous because, as I always say, there's a difference between a wife, a mother, and a widow. A widow thinks differently than a wife or a mother thought, because especially if she hasn't handled the finances, when
Right.
the husband dies, she becomes very cautious and very concerned and protective, and sometimes doesn't do things the right way because of that. So
And
that's a
oftentimes she doesn't have the knowledge either as to what's best for the company if she has not been involved with the business.
right. But sometimes, even though that, you know, isn't best for the company, that's not how she or he is thinking in that
Right.
scenario. They're thinking about
Because
what's
they're
best for me.
emotionally involved.
You know, what's
Absolutely.
best for me.
Yeah.
You know,
Yeah.
like, I don't trust my 32-year-old son yet. Like, you know, he's only been in the business 2 years. Like, I don't want him taking these big risks in the business. I want to keep getting my $500,000 or $1 million or whatever it is of income out of the business that I was getting, and thus does, you know, is unwilling to let the son do anything, even though the son over years proved how they built the business to a much bigger business.
So in a case like that, really it's so crucial to have a family gathering to be able to explain, what are the implications and what we need to do now in terms of planning so that everybody's going to be better off. So in a situation like that, what are the next steps?
Well, look, it's a good point. Look, I think when a child comes in the business, it's really important. There's a lot of very important things, in my opinion. Number one, does dad or mom really think this child is right for the business, or is it just that it's their son or daughter? The
Right.
son or daughter has to say, is this something I really want to do, or am I coming into business because I either feel pressure from my parents, or I can't find myself, and I can make myself a couple of $100,000 a year in my family's business, which is a lot more than I'm going to make outside, so I come into business. The other thing that I think is really important, going back to the prior scenario I gave you, is
Mm-hmm.
that if I'm a child and I'm coming into my father or mother's business, one of the conversations I would have with them is, I need to understand something. You know, I get that I'm at this moment, I am not necessarily ready to run this business. And I realize that I haven't earned anything yet by being in the business today. I'm only been in a year or two. But
Right.
what is important for me to get from you, mom and dad, is what is your plan over the next 5 to 10 years? Because I'm 33 years old. And if I work here the next 10 years, I'm giving 10 of the most important years in my life in building a career. And if it turns out that you're going to just sell the business in 10 years and you're going to get all the money and I'm not going to get anything, or if my brother or sister doesn't come into business, you're not going to start giving me shares, and thus if I have a little bit more control over my destiny, I don't know if I want to invest the next 10 important years of my life in this business without having some sense of that. I'm not asking you for a guarantee. I just want to understand your thought process. Like, where do you, because I don't want to be sitting with you when I'm 43 years old. I still own no stock. I'm now 10 years older. Hopefully I've helped this business. And like, you may not want to give me anything then. And it's like, what am I going to work another 10 years till I'm 53? It's like, I got to have some idea of what your long-term vision is. And that's why I think all those kind of conversations are important. And a lot of those conversations are like almost taboo. Like, the
Yes.
son or daughter doesn't really want to upset the apple cart. Mom
Right.
and dad doesn't want to upset the apple cart, because there are certain things like in that movie, A Few Good Men, you can't handle the truth.
You're
There
right.
are a lot of people can't handle the truth. Like, they
So
just
true.
can't. They just can't. And it's like, if I just either avoid the conversation, or I'm not truthful, I could just keep, pushing this down the road. And
Yeah.
sometimes you need to handle it in a professional way as a business, and deal with the truth. And if the truth means the son or daughter doesn't want to stay in the business, or the son or the parents don't want the son or daughter to stay in the business, the earlier you have that conversation, the better it is for everybody.
Yeah, I think so too. And because this is such a family planning succession is such an emotionally loaded, quest, it's so important to have somebody like yourself who is going to be an impartial, arbiter, almost referee, who is going to work with an agenda over a number of months to be able to take recognize feelings that people have and objections and challenges emotionally for the individuals as well as for the business in order to come up with a plan that is going to not only protect, preserve, but minimize the taxation that is a very tangible and real cost associated with the business. So
Can I address that? Because what you said, I think, was a very, very good point. Um, I think there's a couple of things that generally are important for planning to succeed. Number one, you need a business owner who is not afraid to have a team of advisors working together with
right.
them. Sometimes business owners like to bifurcate their advisors. They meet with their accountant, they meet with their lawyer, they meet with someone like me, their financial advisor, almost because they want to be in control. Like, if they're in a room and all the advisors get together and they all agree on a plan, that may not be the plan the business owner wants. It's much harder for the business owner to poo-poo it if simultaneously all of the advisors tell them to do something. The
Right.
second thing that's important is that egos don't get in the way. Generally, there's one advisor that has the biggest influence over the client. It's normally the CPA,
Right.
but some and sure that one advisor doesn't try to kind of bully the other advisors because they want control. And then the third thing, which is a point you raised, which is valid, is generally the accountant attorney are not objective. Their relationship is with the entrepreneur. Okay.
Right.
They're going to side with the entrepreneur. That's where their bread is buttered. They don't want to lose the client. So when they're involved in the planning, they're going to generally be looking at what's in the best interest of the entrepreneur. Someone like myself, if I'm brought in, I'm trying to look at the whole picture because I don't really serve any other purpose other than doing this. So if I'm not involved in this process, you don't need me,
Right.
So I try to take more of a neutral approach to really tell everybody the pros and cons of everything without an agenda, because I don't have that long-term relationship that I'm getting paid a certain amount every year by the owner, and I don't want to upset the apple cart. So
Yeah.
usually it's either an owner that doesn't let the team work together, a team that has somebody that isn't a good team player, okay, or a
Yep.
team that has people that feel that they have to side with the owner because that's where their bread is buttered. Those are some of the other things that cause planning not to work effectively.
Yeah, and also, as at the beginning again of the conversation, we talked about who owns what kind of stock, and if a business owner, let's say mid-sized business owner, has another business partner that has a certain percentage of the business ownership, that creates another challenge, and I think it's crucially important to determine on what basis is the business going to be valued in the event that, let's say, the children decide to buy out the partner, correct?
Yeah, well, you raised another very good point on a issue that is very complicated. So
Yeah.
let's take a position, Maria. You and I are in business together, and we're 60 years old, and we've been in business together for a while, and we have a buy-sell agreement. You own
Right.
50%, I own 50%. The company's worth 20 million. I have 10 million of insurance on you. You have 10 million of insurance on me. If one of us dies, we buy each other out. But now one or both of us has a child or children in the business. So they've come into
Correct.
business. So let's think about this. I have a son who comes into business. Right now, I would really have, if I was being honest with my son, I would have to say to him, son, before you come in this business, let me explain something to you. I have an agreement in place with Maria. If I die first, she buys me out, which means if you're in this business and I die first, you may never own shares in this company because Maria's going to own 100% of the company. She's probably not going to give you any ownership in the company.
Right.
So before you come in and invest important years of your life in this business, I have to sit down with Maria and have a conversation with her. And here's where the problem comes in. Let's say you don't have any kids in the business, only I do.
Correct.
You're going to say, well, time out, Steve. Like, with all due respect, your son's a nice kid, but like he's 30 years old. Like, I don't want to be partners with your son. Like, if you die tomorrow, I don't want to be 50-50 owners with your son.
Right. Yeah.
I don't, and I can't tell you 10 years from now, if he or she proves themselves, that I may not change my mind, but I'm not going to do it today. Then I have to have an honest conversation with my son that, look, Maria's not willing to change our agreement. And look, I'm a man, she's a woman, just statistically, we're the same age. I'm probably going to die first. If I go first, she's going to own 100% of this business. So obviously that leads to conversations. And there's things that could be done where at death, my son gets non-voting shares, and the voting shares you get for a period of time. But you can't take advantage of him. You could run the business, but you can't pull all the money out of business. I mean, you could set up complicated things, but that again is an example. And it would be, even if we both had kids, I may say, I don't want to be partners with your kid, and you don't want to be partners with my kid, but each of us want our kids to come into business. That's another thing that just leads to really complicated
Right.
and difficult conversations.
Yeah, because that will have to be part of the articles of incorporation or some sort of document that has that as part of the business, correct?
Well, it depends. If you have an agreement, that agreement's going to supersede everything. If the
Hmm.
agreement says we buy each other out, doesn't matter what everything else says. If we don't buy, like if we let our kids get the stock, then we could have things in the agreement and in our documentation that stipulates, okay, at the death of the first of us, what happens? So as an example, we have a business. I pull $1 million out of the business. You pull $1 million out of the business. Okay.
Correct.
I bring my son in the business. You may say to me, Steve, I get $1 million, you get $1 million. If you want to pay your son $100,000, then you're only going to get 900,000 because I want to still get $1 million.
Right, right.
Now we both have kids in the business. You die, Steve. Does your kid get your $1 million? Okay. But my kid's only getting paid $100,000. So like when you die, your kid's going to make $1 million and my kid's going to make 100,000 and they're the same age. Like, do you think that's going to cause conflicts when your kids live in a totally different life than my kids live in, even though they're kind of doing the same thing in the business? So it just shows you how every one of those things is an issue. And my job, I tell people, my job is not to tell you what to do.
Right.
My job is to tell you what are the different things you could do and what are the pros and cons of each of the different things that you could do. And then you have to make a decision. And you're a business owner. And once you make a decision, I'll just remind you, remember, these are the pitfalls of that decision. And if they're ready to live with it, great. Because I can't tell you this is the right way, that's the right way. That's a personal decision. The problem is most people either make a decision because they didn't do planning and it just happens.
Right.
Make a decision.
They are reactive in that case. Yeah.
All the other ways they could have done it. Once you understand all the ways, then you got to make the decision.
So just tracing back just a little bit, we were talking about having keyman insurance in each of the partners. How do they value the business in order to arrive to that dollar amount, whether it's $1 million or $100 million? What is usually based on cash flow? On what have you usually seen, a multiple of net or income? What has been a formula that is mostly used?
Okay, so again, a good question. The insurance and the value don't always go hand in hand because sometimes you buy insurance when the value is low and then the value goes up and you never buy more insurance. And sometimes you buy more insurance. So put aside the insurance for a minute and focus on the value.
Right.
Generally, what most agreements state is that once a year, you're supposed to get together and sit down and come up with a value. And if you don't, which almost nobody does. So
right.
Even though it says that.
That's why I bring it up. Yeah.
Nobody does. I'm going to say nobody. I don't mean nobody.
Most people.
I mean a very small percentage of people do it. So then the agreement says things like it could either say, okay, if for the last 12, if more than 12 months have gone by without the two of you agreeing to a value, then it's some formula. It could be, 5 times EBITDA, 10 times EBITDA, 2 times sales, or many times what it would say is, if let's say I die, my family will go out and hire an appraiser. You, Maria, will go out and hire an appraiser. Now we know what's going to happen. My appraiser is going to value it high. Your appraiser is going to value it low. So it'll usually say, if we both hire an appraiser and it's within 20% of one another, you split it down the middle and that's the price. If it's more than 20%, which it probably will be, then my appraiser and your appraiser, pick a third appraiser. And that appraiser's valuation is binding because now that appraiser has no agenda.
Right,
There were
it's more
two other
objective.
appraisers. So
Yeah,
they're totally objective. Okay. So
yeah,
there's no, it's like, oh, he's going to do what's right for me. And you could set it up where their appraisal has to come in between your appraiser and my appraisal. Like there's a floor and a ceiling.
yeah.
And if their appraisal comes in above the ceiling, then it's the ceiling. If it's below the floor, it's the floor. And if it's in between, that's what it is. That's one way of doing it. If we're both alive, to me, what I think is the best valuation approach, if we're alive and we want to buy out, is what I call the shotgun approach. Meaning, I come to you and tell you what I want you to pay me. You
Mhm.
have the right to flip it and make me buy you out for that amount. So I have to know when I come to you with an offer for you to buy me out that I'm fair, because if I'm asking for like a ridiculous number, you could turn around and force me to buy you out for that amount of money. So it forces me to be fair because I know that if I know the business is worth $10 million and I think I should get five, and I come into you and say, buy me out for $15 million, and you say, great, you don't have to buy me out for $15 million. I don't
Right.
want $15 million to buy you out. I know that's ridiculous. So it forces me to be fair in the negotiation because I don't want the tables flipped on me. So those
Right.
are some of the ways it's done. The insurance on death, obviously, every couple of years you should kind of look at how the business is doing and say, okay, like where are we today? And let's figure out how much insurance. Usually what the agreement will say is that if the insurance is greater than the amount needed, the deceased family still gets the full insurance amount. But if the insurance is less than the amount the deceased family gets, that's the down payment. And then the balance is paid out over 5 to 10 years at some, prevailing interest rate, prime, LIBOR, some kind of rate of interest.
So it's, as we could see, it is highly personalized, right? Because it's just depend on the nature of the business, cash flow of the business, the people involved, whether, how many partners there are in the business. So really the best thing that we could suggest our clients is if they haven't yet thought about business succession and planning, they need to start at some point, right? And the best way to go about it is to be in meetings with advisors and get their opinion. And even in many cases, I have seen business owners that actually speak with their client base as well and let them know, what their thinking is, and especially if they're having their sons take over the company. So those are important considerations. What in closing, give us your final advice.
Well, I'll address that because it's a very good point. I think the two best pieces of advice I can give to an entrepreneur is be involved in study groups with other entrepreneurs, like talk to other people that are in similar situations to you. Not that they're right or you're wrong or vice versa, but just to hear different opinions. So I think
Yeah.
it's important. The second thing is to be open-minded. One of the biggest problems that I find is, let's say you introduce me to somebody, I call them up on the phone. Their first response, I did this already. I did it already. I have an accountant, I have an attorney, I did it already. Now, I'm not here to say they didn't do it already, and I'm not here to say that it wasn't done fairly well. But your expertise, you're an electrical contractor, you're a builder, you're a real estate owner. You're not an expert in this. You don't know that it's been done right. You only can hope it was done right. So be open to listen to other people, because they're not necessarily going to say your advisors did a bad job, but maybe they'll come with a different angle than something that's been brought to you by your current advisors. And it's always important to be open to listen to people. So I think openness to talk to new advisors and the willingness to talk to other entrepreneurs, I think, are two of the best ways to improve your chances of doing good planning.
Yeah, especially, as life changes and laws and taxation changes, that has a direct impact. So it's important, such as like your will or your trust, it's important to analyze them at least, every 2 years. I always recommend analyze it every year because life changes, right?
Life
So,
changes,
yeah, so it's very
100%.
important. Yeah, I found it very important to do that. I know we have gone over our time because this topic is such an important topic for our clients. So I'd like to close just by asking you a silly question, and that is, if you had not been in banking, an advisor, a CPA, an MBA, what would you have chosen in this life?
It's a good question. If I put aside the financial components to things, um,
Yeah.
I love teaching. I love education. Um, you know, I probably, I mean, I could have been a teacher, or I could have ended up being an entrepreneur somewhere in the education space. That's where my passion is. I've done charitable work in those areas. I've been a big brother to somebody for, wow, now it's like 15 years. That's my passion. So it probably would have been. And when I ultimately hang it up, uh, getting involved in charities that pertain to education and maybe sponsoring underprivileged kids in their education and stuff. That's kind of where my passion is.
That's very interesting, Stephen, because I do a lot of nonprofit work with the American Association of University Women. We promote education and pay equity for women and girls. I've been doing that for over 25 years, and it's very rewarding, to be a mentor, to be a teacher, just to help somebody else have a little more clarity in their thinking. And I think in many ways you do that with your clients, to help them have a more comprehensive approach to their businesses and to, in a way that they're able, once they have built their businesses, they want to be able to preserve that business. They want to be able to enjoy it in a way that is equitable and fair for everybody based on the aspects that we have discussed.
Yeah, well,
So,
it's interesting because the education side, the way I put it in almost a business vernacular, is that you can take a child and turn them from a liability to society to an asset to society
right.
just by education. To me, education is the single most important way that we're going to reduce poverty, especially with where the world's going, because we're going to have to educate our kids differently because the world that kids who are 3, 4, 5, 6, 7, 8 today are going to come into with automation and robotics and AI and all. I mean, many of the jobs today aren't even going to exist at that point in time. So not only do we have to educate them, but we have to educate them for the world that's going to be, not the world that has been.
Yeah, and we have to keep that humanity aspect of it, which is something that we sort of take for granted, right? And we're becoming so technologically involved. And there are many benefits to technology, but I think that we need to have that balance between
100%.
the two. So I thank you for the opportunity of, educating our guests and ourselves because we have fun while we do this. There are always ideas that we explore. So I'd like to thank you, our audience as well, and Maria Ellis with Financial Legacy, and our precious guest, Steve Goodman. So thank you again. Here at the Financial Legacy Podcast, we're changing lives one person at a time to help you, the business owner, with your financial legacy, family planning. Please contact us, connect with us at financiallegacy.life. And how can they reach you, Stephen?
Thank you. A couple of things. They can go to stephengoodman.biz and download a free copy of my book on business succession planning. They can go to my website, which is SHG Planning. I have like about 70 articles that they could download. There's some podcasts on there as well. My email is sgoodman@shgplanning.com, and best number to reach me, 516-297-7390. And thank you, Maria, for having me.
Thank you. Thank you, Stephen. Be well.
In providing answers, neither Maria Ellis nor the Financial Legacy Podcast and guest speakers are acting as certified financial planners, advisors, certified financial analysts, CPAs, economists, accountants, or lawyers. Neither Maria Ellis or the Financial Legacy Podcast and guest speakers make any recommendations as to any specific securities or investments. All content is for informational and general purposes only and does not constitute as financial or legal advice. You should consult your own tax, legal, and financial advisors regarding your particular situation. Neither Maria Ellis nor Financial Legacy Podcast and guest speakers accept any responsibility for any loss that may arise from accessing or reliance from any information in this podcast. And to the extent permitted by law, we exclude all liabilities for any loss or damages derived directly or indirectly arising from the use of the information.